which is finally the start of trading ICT concepts. Hopefully you've all read through the ICT document. So yeah, this is where it starts getting fun and exciting because we are now learning how to actually trade. We've gone through all the basic trends and candlesticks and everything, and now we get to learn the actual building blocks to entering trades and why we're taking them. So no, it will be good now. So stick with it. And yeah, so the first topic is liquidity, as you know by the title. And I might split these up into a few different videos, as in like a part one, part two, just to break it up a bit. Otherwise, it would be like one really long video. So I might split it up. So hopefully you've all read the document, the PDF. So I might talk through this a little bit first. So where are we? If this looks different to yours, don't worry because this is like a first draft that I've done now, but the one that your guys are reading will be the final draft. So if it looks a little bit different, then don't worry. But it'll be pretty much the same. So liquidity is essentially resting orders in the form of buy and sell stops, meaning that where there's liquidity, there are tons of stop losses. So you've got your liquidity, the stop losses above. This is super important as the market movers seek and take liquidity out. And of course, we know that we want to be trading like the banks. Therefore, we have to be able to spot liquidity. The banks and institutions need liquidity to move the market, so it makes perfect sense for them to take stop loss orders out so that they can fill their own orders. So we know that liquidity is where resting orders are, but how do we actually know where it is? Yeah, so liquidity is literally resting orders, guys. So where you place your stop loss, that's technically a resting order because your stop loss hasn't been hit yet, and when that's been hit, the order's filled. So banks love to target these highs and lows where there's tons of liquidity above them and below them. So where to find it? So like I just said, it's found at highs and lows in the market. It's super easy to spot. The highs are called buy side liquidity and the lows are called sell side liquidity. It's literally as simple as that. So let me just hold up there for you guys to look at. So lows called sell side, highs are sell side. All of these highs here are also buy side liquidity. These lows here are also sell side liquidity, but I haven't marked them out just to make it easier for you guys to look at because these are the main points of liquidity. We can see yeah, so buy side liquidity are the highs, sell side are the lows. Above the buy side liquidity, there are buy stops. Below sell side liquidity, there are sell stops. Again, you don't need to know that, you just need to know how to mark out liquidity. So you need to know to mark out the lows as sell side and the highs as buy side. So above this high, there are tons of stop losses from where people have entered short around that area and placed their stop loss above the high, as that's the most logical place to put it. Yeah, so above this high here, people who would have gotten short around here, for example, are going to put their stop loss above here because that is the most logical place to put it. Meaning if price came up now, it can take out those orders and then come down. The same with sell side. There are sell stops below here from where people have entered long in the market here and put their stop losses below here. So price could easily swipe that out and come up because there's sell stops below here. So banks want to take those out so that they can fill their long orders up here by taking other people out the market. Because as you know that if someone buys, someone else has to sell. So if the banks are taking out sell orders, that means they can fill their buy orders. And the same for the opposite way around. If banks can take out be buy orders, they can fill their sell orders, take it out and sell the market. That's exactly why banks like to target these areas of liquidity, as they can take traders out of the market whilst filling their orders to then go and push price in the opposite direction. So in the example, the market movers may push price below sell side liquidity, taking out mini stop losses. Yeah, that's just what I've gone over. These are the type of moves that us ICT traders capitalize on, i.e. we wait for one side liquidity to get taken out, then wait for some sort of reversal and then place a trade and target the opposing side liquidity. So yeah, us ICT traders like to wait for one of these to get taken, wait for a sign of reversal, which we'll go over, and then we can target down here. And same for the opposite way around. So yeah, they're all the highs and lows, but I just didn't mark them out just to keep it a bit cleaner on this chart. Here's an example of when liquidity gets taken out. Okay, cool. So we have our buy side and our sell side. These lows here are our sell side liquidity. Then price came up, we made some buy side, came down, and we took out this low here. We took the low out. The orange circle, look, we came down, took the low out. And then what happens after? We reverse, because the banks have taken out all of the sell orders, the sell stops, they've taken out and been able to fill their buy orders and push price up towards buy side liquidity. So this is called a liquidity sweep. You take out liquidity, push price in the opposite direction. Liquidity sweeps tell a huge story. If a major sell side liquidity gets taken out, then there's now a high chance that price reverses and heads towards buy side. Liquidity fuels the market. Every single move is going towards liquidity, whether that be buy or sell side. That's very true. Just remember, above previous highs and below previous lows, there's money resting, waiting for banks to take it out. We then trade in the same direction as the banks after they take out liquidity. So all you need to know is to mark out highs and lows and treat them as liquidity, because that is exactly where it is. Right, so now let's go on to the charts and have a quick look. And we'll go through the highs and lows. So I'm just going to pause the screen here and let you guys, give you 10 seconds or so just to mark out the highs and lows. So mark out the buy side liquidity and mark out the sell side liquidity in your head just for a second. So mark out the buy side and mark out the sell side. Ones that haven't been taken out yet. There's yet to be a liquidity sweep. Okay, cool. Okay, buy side. So we're currently trading down here. Our main buy side points here, here. Sell side. Let's change the color. Blue. It's been taken out. So sell side. So I'll pause that for a sec. So that is literally it, guys. If you want to mark out buy side liquidity, you are looking for highs. If you want to mark out sell side liquidity, you want to mark out the lows. That's literally it to find liquidity. And then let's have a look at some other examples. So there's going to be new highs and lows on every single time frame, but I'll go through that more in detail on the next video. So what's this high? Buy side. What's this low? Sell side. That has actually just been taken out, so that's not a great example. So that's literally a liquidity sweep happening as we speak. Sell side liquidity has just been taken out here. And look, you can see that price is starting to reverse after we've taken out that liquidity. But in the next part of this video, I'll go over liquidity sweeps, just to space out the videos. So in this one, I just wanted to go over the document and go over how to mark out buy side liquidity and how to mark out sell side liquidity. So lows are sell side liquidity, highs are buy side liquidity, because above the highs you have buy stops waiting to get taken out, and below the lows you have sell stops ready to get taken out. And guys, I know it's probably going to be confusing you by saying buy stops and sell stops and resting orders and all of this, but literally do not overthink it. You are looking for highs and you're looking for lows. Lows are liquidity, highs are liquidity. Highs are called buy side liquidity, lows are called sell side liquidity. That is literally all you need to know. You don't need to know about any orders. None of us traders are looking. There's no program that tells us exactly where orders are. We just know that they're above highs and below lows. That is all you need to know, and you need to know that banks target them. The market movers target these liquidity points. So if they're targeting sell side, they'll take it out, and then what's likely to happen at some point is price will reverse and come up. And if price takes out buy side liquidity, it's likely to reverse and come down. That's all you need to know. You just need to know how to mark out buy side liquidity. You need to know how to mark out sell side liquidity, and you need to know what happens after one gets taken out, called a liquidity sweep, which is what I'll be going over in the next part. So do not overthink anything about orders and stuff. That is literally just me telling you the definition of liquidity in the markets. But you just need to know how to mark out the highs and how to mark out the lows. So they're always going to be the top of the wicks and bottom of the wicks of each candles. And make sure you wait for a candle to close. So this wouldn't be valid liquidity yet because this candle has still got 3 days to close yet, so we wouldn't mark this out. Only candles that have closed. But yeah, that was just in case you were stressing about, oh, I don't know how to see orders in the market, buy stops, sell stops, I don't know how to see it. You do know how to see it because all you have to do is mark out the highs, mark out the lows. And I'll go over in the next videos liquidity sweeps and like how important prominent highs and lows are, and why lower time frame liquidity is not as important as the higher time frame liquidity. But I'll go through all of that. So just all you're taking away from this video is buy side liquidity, sell side liquidity.